Mike Santoli remains here as well. Mike, I liked your metaphor for today's market. It's like a new relationship. What was it like today?
Well, where you say, well, isn't it nice we don't have to really talk? We can just be together. I think it's waiting for an awkward silence to end because the market does not have a good, clear read on what the next bit of direction is. I do think that it was interesting. We got a couple of very fleeting bounces when we got a vaguely promising China trade headline. But in reality, what we did was, we kept most of the Thursday, Friday bounce. I think a lot of people are putting a lot of credence in that reversal we got to the upside after Thursday morning's weak economic numbers. But we still remain kind of stymied a few percent below the highs. This 2940 level in the S&P, we're back to it again. It goes all the way back to last September, basically.
Dan, we saw a little bit of selling there into the close. Does that signal anything for what's to come tomorrow or market jitters that just came ahead of the trade talks this week?
I think that we were 2-3% off the lows from last week, and those were on commentary that maybe we might have some sort of deal that's somewhat unexpected. I just don't see that happening, so I would fully expect if we get to the end of the week and it looks like there's not going to be any real progress to retest those lows near term. But again, remembering that we're just a few percent from the all-time highs. It's far from a disaster. I just want to make one point. What Mike said as far as interest rates today, I think is pretty interesting. So you have the 10-year at 1.55, 1.56 or something, but the yield curve did flatten a bit. And what didn't like that? Banks didn't like that, Wilf, and so that's a group that when we talk about rotation that we've seen had a good quarter last quarter, but then once that yield curve inverted, the bottom kind of fell out. So that's a group that I think you want to keep a close eye on.
Michael, what's your take on the headline from last week? Bad data, but is that offset enough by expectations for more rate cuts?
Yeah, I think it is. I think bad data is really, frankly, an overreaction. I think that headline is just way too dramatic. The economy is actually not as bad as people are thinking right now. Now, it may worsen in the future, and we'll see how the trade situation goes. But I expect there's going to be some minor movement on the trade side. And if you look overall, the economy is doing okay. We still have reasonable corporate profits this quarter. As was said by a guest last hour, the underlying unemployment report was actually pretty strong. So I think it is a positive sign that the markets bounced back after those lows last week. I think there's still plenty of money on the sidelines looking to get in at any sign of weakness.
Goldman Sachs was out with a note today saying that the economic run is not over and the U.S. is, quote, not close to recession. Meanwhile, JP Morgan saying one should not expect a U.S. recession over the next 12 months. And just last week, Citigroup with a note saying that the bull market is old but not dead. Mike, what's your take on the sentiment of the big Wall Street brokers? Perhaps those three are not totally reflective of a bit of a shift lower in risk gauges over the last couple of weeks.
I would say not entirely, but what it most tells me is the questions they're getting from their clients. Because these three reports were answers to the overwhelming questions that institutional investors are asking, which is this the end of the cycle? And that's been the fundamental question at the crux of the markets really for months now. So I do think it shows that they're saying, look, the weight of the evidence right now does not say we're tipping into recession. But in general, I also don't think you see Wall Street sentiment projecting a real reacceleration from here or a lot of upside. I think, it's interesting. Citi said, yeah, we think maybe we can go up 10% or so in the next year plus. That qualifies as very bullish, even though that's essentially saying you're going to get roughly the historical rate of return in the market over the next year. And that sounds very aggressive. I think it tells you have relatively muted expectations out there.
Michael, it says here in your notes that you're paying an awful lot of attention to interest rate policy as well. We were speaking just a little bit about what was going on, at least with the yields in that market. Do you think that the Federal Reserve is going to keep us from going into recession using that interest rate policy tool that they have at their disposal?
I think they're going to help, and I think they're going to cut another 0.25% this year and then kind of see what happens. But again, I think it really just comes down to what's happening in trade. If you have a freeze up of infrastructure spending, CapEx spending, not only here in the United States, but around the world, and particularly in China, I think that's going to be more harm than perhaps the Federal Reserve starting to slow down their interest rate cuts. So I think the Fed can do what they can do. But in the end, if you have frozen trade policy, if you have a situation where CapEx is just not being expanded and companies are very slow to expand their services, I just really think you're going to have a real difficult time staying out of a downturn.
Dan, quick final thoughts in terms of what you would be deploying cash into for the rest of this year. Which sector stands out for you?
Treasuries. I mean, here's the thing. We're going to zero. It's just that simple. You know, Jay Powell back in July said this was a mid-cycle adjustment with that first rate cut in 10 years. It's becoming a rate-cutting cycle here. So the longer this trade war goes, the worse the global economy does, and the Fed is going to have to do everything in their power to kind of stimulate demand. And so to me, I just think that, you know, it hasn't been a great opportunity to buy the S&P 500 within a couple percent of its all-time highs over the last 20, 21 months or so. So I wouldn't be doing it here right now, especially given all the uncertainty.
Fair enough. Dan Nathan, Michael Yoshikami, thank you for joining us here today.